Hi, hello. Okay, today we present a work with Stefanos and Georgios from Singapore University. We address the question, do cryptocurrency prices camouflage latent economic effects? And what do I mean by that? So we know, I think everybody knows better than me here, that we have this whole blockchain technology. It creates new ways of trust and cooperation between individuals in this trustless, if we can say, environment. And one very prominent application of this blockchain technology is the interaction and the value creation in decentralized markets. But can we ask if we do this hypothesis, if the cryptocurrencies create the new economies that they promise? So we ask if we have new economies and if we have enough tools to examine these hypotheses and study these hypotheses. Traditional economic models now fail to understand this hybrid structure. We have that the cryptocurrencies are assets that can be viewed in financial markets. They have econometric properties, they have high volatility, they have heteroscedasticity, they have asymmetric effects. But on the other hand, there is an underlying game theoretic structure as introduced by the miners' incentives, by the blockchain technology, by the consensus mechanisms, etc., etc. So we have a lot of earlier studies that provide some mixed insights. So we ask, are cryptocurrencies independent of existing economies? Also, if they are not independent, how these financial assets relate to macroeconomic fundamentals, and also how does this underlying structure that I talked in the previous slide affect the observable market? We need an econometric model, so we need an econometric model to capture first the incentives and the technology. We need an econometric model to capture the relations and the possible links to the existing markets, and also we need a model that can, as it can, model the unobservable economic effects. Okay, so in this study, we use the hidden Markov model, which is a Bayesian algorithm, basically, that is newly developed. In the studies, they've shown that it outperforms benchmark models in conventional financial data set, and it's called non-homogeneous polygamma hidden Markov model. This model can capture some cryptocurrency-specific challenges. So we don't know if there are any and which are the predictors. So this model can identify this. And also, it can model the underlying structure as introduced by the miners and incentives, etc., etc. Here we use the non-homogeneous polygamma model to model the Ether and Bitcoin price series in a long and short term. So what is this hidden Markov model? This is a slide that I tried to make so we can understand what is this model, and these are the some of the maths behind this model. I don't think it's necessary to talk about this. I think it's better if I stay in this slide. So let's start by the yellow circles. The yellow circles are the Ys, which in our case is the Ether or Bitcoin price series. Actually, we use the logarithmic price series. Okay, this observed series might or might not be affected by the economic effects, which here I denote them with xi's, it's here. Okay, and now what else can affect this series? This series can be affected by all this underlying structure. We talk about blockchain, etc., etc. So this information can be captured in these yellow circles, the unobserved states. And we don't know a lot of things about these unobserved states. So we allow the states to transition from one to another in a probabilistic way. Again, that might or not be affected by the economic effects. And what do I mean? So I'm skipping this. So what do I mean by economic effects? In this study, we used a mixed variable, explanatory variable set. We use exchange rates to see if there is any connection with fiat currency, if they are related. We used market indices and uncertainty indices. Also, consider that the cryptocurrencies are mined, so we used also commodities. And finally, we used some cryptocurrency-specific variables to account for the game theoretic aspects. What are the results? So these are two plots. One, the above plot is for the Ether price series, log price series, and the bottom is for the Bitcoin price series. The blue line, in both cases, are the logarithmic price series for Ether and Bitcoin. And if you can distinguish, there is a gray line that actually captures this blue line. This is the estimations that we have, the in-sample estimations. You can see that in the background we have shaded bars, white and the shaded blue or grayish bars. These are the hidden states that this algorithm estimated. We have on the horizontal axis the time frame. We used in this slide, I show results from a data set starting from June 2016 to June 2019. So let me go in analyzing a bit these plots. So we had a rather good in-sample performance. That means that this predictor set that we used explains some of the crypto price formation. Specifically, we found that Nasdaq and hash rate are significant both for Ether and Bitcoin. We found that the Ether is more geographically restricted in the sense that there are less exchange rates included in the significant predictor set. And also, when we run the Bitcoin price series for a long and for a short term, we found that Bitcoin is starting to get more and more independent, and this is shown by the fact that less predictors are affecting the series. And what about the hidden states, these shaded bars in the background? We can see that there are frequent alternation between one another state. And that means that the model accounts for the heteroscedasticity, the periods of high and low volatility. And we might interpret this. One of the interpretations is that there is different trading activity in these two states. We might have noise traders versus fundamental investors. Okay. I think we found that we understood all the cryptocurrencies, and if you think we are happy, we can go down, but I don't think that Satoshi is very happy about that. So let's see, what did we miss? We missed that if we want to predict the values, we don't do really well. I mean, we don't follow the price. If you see the gray line, it does not estimate the blue line. We try to predict 30 days of the log price series for Ether and Bitcoin. And what does this show us? it shows that the series variability remains partially unexplained. We found that the past values of the log series are significant, and that means that one might use this previous information to do speculative training. He can form a strategy to form better or more profitable strategies. But if I may ask, do we think that these news are good or bad? I will say, if we consider how we started, that these are good news, because if we cannot predict the prices, that means that there is an indication that we may have an independent market or new economy. So what is the main takeaways I want you to take home? So we had a hidden Markov model. We used it to give a dual perspective on cryptocurrencies. We had the financial market dynamics on the one hand and game theoretic aspects on the other side. And we know, we have an indication that these cryptocurrencies are unlike well understood assets. That means we might have new economies, and also that the economies are heading towards independence, and that means that indeed technology matters. And I think now he's more happy, Satoshi is more happy, so I want to close with some extensions. One might use the deep learning methodologies to extend this new model, this non-homogeneous hidden Markov model, or one can use high-frequency data in this setting. We believe is promising. I think I have time for questions.
Two or three questions. So
thank you.
Please.
Yes, please.
First of all, thank you for presenting your research.
Thank you.
Very interesting. My question is, have you tried any other models and besides Markov model, and did you find that they don't fit well, or what was your experience? And the second is, in terms of the high frequency data mixed, what do you mean by that?
Sorry?
The mixed high frequency data, you don't get any conclusions and correlations?
We haven't tried that yet. It's ongoing research for us. Yes, we mean that if we use TikTok data or something like this, if there is any connection, or if we can get a better understanding for the price formation, that is what I mean with high frequency data. And as far as the other models, we tried regressions, different autocorrelation. We used more lags in our series, but we didn't get any better results. And also from the work on the literature review that we have done.
Thank you very much.
Thank you.
Thank you for sharing your research.
Thank you.
Very interesting. One question.
Yes.
First of all, you have touched upon a very important dimension of such systems, the game theoretical aspects, which the whole dynamics and this dynamic shift on blockchain-based systems, especially the permissionless ones, are very important. However, my question is with regards to if you have tried this model into any other public blockchains or semi-public blockchains?
No, we haven't done that yet.
Do you have any plans for extending in more data sets?
To be honest, I didn't think about semi-private, but we were thinking about high-frequency data, but this is also a very nice idea. Thank you. Thank you very much.
Thanks.
So it seems that we have no questions, but I have one for you,
Thank you.
Constandina. So once again, congratulations on this excellent work. Can we go a few slides back
Yes,
on
please.
the plots?
The
So
first one or the second one?
the next set
Okay.
of plots. So I would like to ask, you have calculated an evaluation metric just to have
Mean square
quantitative,
errors and
which is
so we use the mean square errors. That is actually the distance between the actual value and the value that we estimated, and we compare this with other simpler or different models, and we didn't have much differences.
Is there a baseline approach for this experiment, just to understand, the benefits of your model? What's the baseline, even a naive baseline? What's the naive estimator of these prices? Just to have an understanding how
Usually in statistics, we use either a homogeneous model or regression to have the baseline how we can treat it.
So the question is your model exists the baseline approach?
Yes.
So
yes, but it's not enough.
This is all my impression, and this leads me to the next question. I see, despite the fact that the current state of the model seems to have, let's say, weak prediction power for this particular setting. To me, it seems to have some considerable power if we consider a different setting. Imagine having a model in place trying to predict, let's say, the polarity of the trends. In the simplest case, this is a binary, scheme. That is a price going to exceed a threshold or not? My suspicion is that in this setting, your model will yield better performance. So my suggestion is to better investigate the performance of this exact model before trying to proceed to improvements like the machine learning based on deep learning nets case.
Yes, actually, if I may say, if I have time, I don't know.
Yes.
Okay. This here does all the work of the job for you, what you are telling about. This polygamma model that we have inside the non-homogeneous model is actually very powerful and very well studied, starting from 2013. And it has very good performance in binary sets, binary data, binary outcomes. So, yeah, I haven't thought about that, but I think it's worth it. It would worth it. Okay. Thank you.
Thank you.
Thank you very much.
Once again, congratulations.